What's happening in the market today looks calm on the surface, but underneath, something important is changing. Tech is under pressure, yields are moving lower, and the Nasdaq is clearly weaker than the broader market. This is not panic, but it is a warning signal. Let's break down what today's price action is really telling us.
Let's start with the bond market, because that's where the real story begins. The 10-year Treasury yield is down to around 4.14%, losing almost 0.75% today. That's not noise, that's money rotating. When yields fall like this, it usually means one of two things. Either investors expect slower economic growth, or they're positioning for less aggressive Fed policy. What matters is this: capital is moving into safety. And historically, when bonds move first, equities react later.
Now look at the Nasdaq. QQQ is down more than 1.5%, and the selling has been consistent throughout the session. There's no panic selling, but there's also no strong dip buying. That's a key difference. Tech stocks are expensive, valuations are stretched, expectations are high, and when uncertainty increases, this is the first place money leaves. As long as QQQ stays below the 620 to 622 zone, pressure remains. If that level breaks decisively, downside momentum can accelerate fast. Compare that with the S&P 500. SPY is down, but noticeably less than QQQ, about 0.7%. This tells us the market is not collapsing, it's rotating. Money is leaving high beta tech and moving into more defensive areas. That's typical late cycle behavior, and it often happens before larger moves. The key level to watch here is 688, 686. Hold above it, and we're looking at consolidation. Lose it, and the broader market follows tech lower.
What's interesting is sentiment. There's no fear, no panic headlines, but optimism has clearly faded. Traders are talking about healthy pullbacks, waiting for data, repricing expectations. That kind of language usually appears before volatility expands, not after. Quiet markets are often the most dangerous ones. So here's the takeaway. Bonds are moving first. Tech is losing momentum. The broader market is holding for now. This is not the start of a crash, but it is a moment where risk needs to be managed carefully. The next 1 or 2 sessions will tell us everything: stabilization or continuation lower. Let me know in the comments, are you expecting a bounce or more downside from here?